Hello guys. In this video, I wanted to do a recap of the major factors that led to the sell-off on the June 5th, the Friday that we just passed. I wanted to point out some important metrics that told us this type of sell-off was incoming, and also wanted to point out some contextual factors as well that led to the sell-off. So obviously, we experienced this big sell-off, I think about 2.5% or so on Friday. And let me go through some of the important metrics that, I personally looked at to anticipate a sell-off. And then we can talk about some, market factors that led to this as well. First metric that I want to look at is SPX divided by RSP. And I talked about this metric as the main point in my last video as well, but it's basically um, S&P 500 divided by RSP, which is equal weighted index. So RSP is an equal weighted index that gives the same weight to Nvidia and the smallest company is the S&P. So this is a ratio between the two, and as we can see, we hit an extremely high number here, so 36, so about 37 around the middle of May, and then we started decreasing. And in the last video, I pointed out that, hey, when the same pattern played out last year around October, November, that preceded a sell-off in November. So if we bring in SPX into this, so recap here. So in the at the end of October, we hit a very large, very high number here, 37, and S&P was at around here. And then as it was decreasing and consolidating, we saw a sell-off here, and we saw a bounce, and we saw a bigger sell-off here. And we saw kind of a similar pattern where as we're hitting a very high 37 of this metric, on this metric, S&P kind of hit a local top here, and it went down as this ratio went down, and then it bounced up, and then as this dropped further, we had a pretty big sell-off here. And if we go further to 2024, July 2024 is another time. That's actually kind of a historic time in many different ways. But this is another time we hit similar number as well. It was 34. And as it was going down, like we experienced a sell-off as well. So when it hit 37 and started decreasing, I felt that we could see a moderate amount of sell-off as well. I just wasn't sure about the timing. And if we bring in some indicators like RSI, we see that right here, it was really overextended. And if we bring in Bollinger Bands, it was hitting the upper bound right here as well, and now we hit the lower bound, and I would probably expect this to bounce up higher. And the second metric that I want to go through with you guys that preceded the sell-off was VIX EQ divided by VIX. So VIX EQ is market cap weighted average of the individual stock level volatility. So I know that was a little wordy, but basically VIX is implied volatility for the next month at the index level, at the S&P 500 level. And VIX EQ is looking at the individual stocks and looking at the volatility associated with individual stock and then taking on average weighted average of it. And as we can see over the last week or so, it was going up towards 3, which again is a historical number. I don't know if there's another time that we hit 3. So maybe July 2024 again. Um, and at the same, and as we saw with the SPX divided by RSP, July 2024, we saw a sell off after we hit this high right here. Um, and we're kind of seeing the same thing here as well after we hit a extremely high number 3. In terms of looking at RSI is overbought as well. And looking at the Bollinger Band, we're hitting the upper range of the Bollinger Band for the last week or so. So we could tell this metric was very stretched and it was due for a snapback. And the last metric that I want to go over is Core 1M. So correlation. So this is implied correlation for the next month. And I pointed out in the last video as well. But when I was making the last video, I believe it was around 8.5 or so, which, you should be worried if the Core 1M gets down below 10 or so. But if you're seeing the numbers in the eights, you should definitely start buying puts. So in the end, we continued to go down and we hit like 5.8, I believe, and we started turning. And when we did have a sell off, it just skyrocketed to 14.5. So the three metrics that I paid a lot of attention to: SPX divided by RSP, VIX EQ divided by VIX, and Core 1M. And all of these metrics, I would say, are mean reverting metrics. So when we look at extreme values, we should expect that it's going to snap back to more of an average or median number, right? So that's kind of a temporary state, and you should expect a change in the market direction when you see something like that. The most tricky thing about that is, though, it's always really, really hard to tell the timing of it. And when I was talking about the SPX over RSP in the last video, like I was thinking that we're gonna see something. We're gonna see a downturn in the market within a week or so. But then there was, positive catalyst from like Dell earnings and Nvidia's GTC in Taiwan as well that really kind of continue to pump positive news about AI and continue to make the stocks go up. So the timing is tricky to pin down, but you should expect some kind of a change in the market direction within a month for sure. But that's when you have to start preparing. And in addition to the metrics that we went over, I also want to go over maybe three main contextual factors that led to the drop. And one is Broadcom guidance and Google's $80 billion capital raise. Two is non-farm payroll report result. And three is Delta hedge unwind on call options. Okay, so we're having a continuous run of record-breaking earnings calls from various AI-related companies. I mean, I talked about Dell. Like, I did not expect um, the level of a positive catalyst from Dell earnings and Hewlett Packard Enterprise earnings, about Edge AI. But during the Broadcom earnings call, um, I believe that they reported good numbers in terms of the earnings and the performance, but just when they were providing guidance on the future revenues and future performance, I think that they were pretty conservative in giving the guidance. So they only affirmed the existing guidance without raising the guidance to signal that, hey, like the AI capex is continuing to increase and AI hyperscalers, the demand for the chips and demand for the AI capex, that's continuing to increase, and the revenue will increase through the rest of 2026 and also 2027. And I think that because they did not do that, although their earnings numbers were good, because they did not signal strong additional growth in the future, the market was disappointed, and I think that the market was probably surprised a little bit, because they expected another the raise in the guidance, and also Google's $80 billion capital raise. A lot of that was coming out of the issuing additional stocks, ATM offerings, so that will dilute the stock price, which I think that impact is probably localized to Google, like that impact is limited to Google. And $80 billion compared to Google's market cap isn't, it's not significant. But I think that it also sparked renewed concerns around the level of capex that's required by these hyperscalers, and again raised concerns around future probability, compared against these hyperscalers investments. And mind you, Google and all the big tech like Mag 7 companies, like they're known for having tons of cash flows, and they've been they've been using up a lot of cash to build up the AI infrastructure and really invest in that. So I think that this probably kind of sparked that sentiment again, sparked that concerns. And I think that there's some news around about Meta doing something similar as well. So this could be contagious to like other Mag 7. So I don't think these were necessarily the major direct factors, but I think these kind of set the scene for the Friday sell-off in terms of kind of killing the AA momentum a little bit. Second, I want to talk about the non-farm payroll report results that came out last week. And I would describe this as more of a direct trigger that started to sell off. So ironically, the result was good. So the new job creation, I mean, that significantly beat the consensus estimate. So we added, 172K jobs versus 85K jobs that were estimated by, various investment banks. So we basically doubled the estimate, which was, really, really, really good and good for the economy. And unemployment rate was low, 4.3%, unchanged, not changed from the previous month. And average hourly rate increased a little bit from the previous month. So, there's nothing really bad about the results. I mean, it's really kind of, basically kicked ass compared to what everybody was expecting. So question is, if the result was good, right? Like, why did this? start the sell off? Like, why was this a trigger for the sell off? To really dig into that, like we have to start with the Federal Reserve's, the dual mandate. So they don't really so inflation is not their only concerns. They have dual mandates that they have to balance. One is, price stability, so low and stable inflation. This is what everybody knows. And two is maximum employment, which is measured by low unemployment rate. So they actually have to kind of juggle these two goals and balance those out. And to reach their goals, they can increase or lower the interest rate. So increasing the interest rate will decrease inflation, but will increase unemployment rate. And lowering the interest rate will increase inflation, but will lower unemployment rate. So as you can see, increasing or lowering the interest rate, I guess that's the weapon that they have to solve the problems. It solves one problem, but could potentially make the other problem worse. And we've been we've been concerned with the potential inflation problem for a while, right? Because we have the increased tariffs, and also nowadays the oil price is higher, so we're concerned with inflation around that. And the Fed's stance around that has been that those inflation coming from the tariffs and the oil are transitory, right, or temporary, right? But there's definitely still concerns around that. And based on the non-farm payroll result reports that we have seen, especially this month, there is absolutely no problem with the job market, right? Like the with the maximum employment mandate, like there's no problem with that at all. So naturally, controlling inflation becomes a bigger problem, right? And to decrease inflation, um, the method by the Fed is to increase interest rate. Therefore, because the job result is so good, the probability of the Fed increasing interest rates is now higher. So the market was repricing this probability on Friday. So as you can see, the probability of the Fed increasing interest rates by the December FOMC meeting jumped higher by 20-ish percentage points. So this triggered a sell-off. But what amplified the sell-off? We can look at the impact of delta hedge unwind by dealers on the call options. So let me go through the dealer delta hedging mechanics specifically on the around the call option at high level. And no worries because don't worry because I'm gonna make a separate video to cover the dealer delta hedging mechanics. So when the market or yourself buys a call or put option, there's a counterparty on the other side that sells you that option. So we call them dealer or market maker. So they operate as a seller of options when the market buy call and put options, right? So say you bought a call option, and when dealer sells a call option to you and the underlying stock goes up, the call option value is going to go up, right? And if you decide to sell that call option back to the dealer, now the dealer has to pay you the profit, right? So that's a potential loss for the dealer. And also, if the call option ends up becoming in the money and is exercised by you, the dealer will have to deliver the underlying stock shares. To hedge against this potential loss, dealer has to buy the underlying share when selling a call option. And if the underlying stock goes up higher, dealers have to buy more shares to hedge against now a bigger potential loss because the call value is going to increase. So as we had the run up in the stock market, this is how things played out. The market bought massive number of call options on the semiconductor stocks and the tech stocks. And when these call options were bought, the dealer had to buy the underlying shares of these stocks. And then the stocks went up further. And because the stocks went up further and the potential loss for the dealer increased, now they had to hedge more by buying more of these stocks. And as the dealers bought more of these stocks, the stocks went up even further. And then the dealer had to buy even more of the stocks to hedge further. So it kind of created this feedback loop that just pushed the stocks up higher and higher. Now let's look at the opposite situation. That was when the stock market was going up and when tons of people were buying call options. Now, after the stock market has gone up, what if the stock market gets hit by a sell off trigger? Now the stocks are going down, right? Then what happens? Now the dealer has bought too many of the underlying shares of the stocks because as the stocks go down, their potential loss goes down as well. So whatever they have bought, now they have to start selling some of that, right? And as they sell more, that will contribute to stocks going down further. And now the dealer will have to keep selling more of these stocks until their potential loss comes down to zero. And what this will do is this will amplify the sell off in the stocks. This will add to the volatility when we have a sell off. And keep in mind, this impact is also going to be amplified on Fridays when tons of the options expire, because that's when the probability of being in the money for the options change most quickly. So, in summary, let's recap all the things that we talked about. First off, the market metrics we looked at were stretched to historical degree, making the market vulnerable to sudden sell-offs. So we looked at SPX divided by RSP, VIX EQ divided by VIX, and Core 1M, and comparing those values against the historical outliers, we confirmed that they were at historically stretched levels, and these are mean reverting metrics. So they are expected to snap back to the historical mean. And also, AI stock momentum that was driving up the overall market were slowing down. Two notable events that contributed to that were Broadcom guidance disappointment and Google and other hyperscalers' additional capital raise or potential additional capital raise. And then and then here comes a sell-off trigger after NFP report was result was reported. It was significantly better than what was estimated by various banks, and that subsequently raised the probability of a rate hike by the Fed. And this triggered a market-wide sell-off. And what made this sell-off, the magnitude of this sell-off worse, was caused by the extreme level of call option buying by the market, and that caused the significant sudden unwind in the delta hedge by dealers. And that really amplified the magnitude of the sell off. So I hope this video was helpful in really kind of summarizing the various factors that led to Friday's sell-off. And in the subsequent videos, I'll talk about my baseline thesis as to how the next few weeks will go in terms of the market movement. And I'm gonna start making some more videos that are educational in terms of like learning the options trading and those type of things. So, one of the topics that are going to be covered um, on those videos is the delta hedging activity by the dealer. So keep an eye out for that. Thank you, and see you in the next video.